Hello, I'm Moira O'Neill, editor of MoneyWise magazine, and today I'm talking to John Pattullo, fund manager of Henderson Diversified Income. John, with the prospect of Brexit and Donald Trump being president this year, what do you think the prospects are for investors in 2017?
Yeah, well, it's going to be interesting, and politics has really reared its head, so there will be opportunities. I think there'll be more volatility, that's for sure. But volatility isn't necessarily all bad because it can present opportunities. And in this vehicle, the investment trust, we can increase gearing, we can increase risk if we want. So that's kind of exciting. And also, secondly, last calendar year, bonds did sell off quite a lot on the back of Trump. So one shouldn't get too bearish bonds as we come into 2017 because they had a bit of a tough time in Q4 of last year.
Okay, so what are the prospects for the bond market this year?
Yeah, well, I think they're not as good as they were because Trump brings in uncertainty, and in theory, he'll make the economy grow more, and that means potentially more inflation.
You raised the issue of inflation, which a lot of MoneyWise readers are worried about. Should they be worried about that this year?
I think globally, not really. Generally, because there's mass excess capacity in a whole host of industries I could name, and there's still not enough demand in the world to purchase the supply that the world can create. Generally, because the world's growing less fast than it used to. Having said that, in the UK, yes, it's going to be tough. I think your readers should expect probably 3% inflation next year, or this year. Sterling is down 18% post the Trump election. And we are importing a lot of inflation. And that will hit food costs and a lot of stuff which is imported. If you're importing in dollars, and sterling, you know, for retailers it's going to be very tough as well.
3% inflation seems high compared to what we've experienced over the past few years. Yes. Interest rates are still very low. What are the prospects for interest rates against that background?
Well, if you look at the 2008-2011 experience, Mervyn King correctly looked through the temporary inflation we were importing and didn't change his interest rate policy. He said, look, I know sterling's gone down. We expect a lot more headline inflation to come in, but it's a temporary thing. It has quite big lags. It can be lagged up to 3 to 5 years, and that was exactly what happened in 2008 to 2011.
So how risky do you think bonds are compared to equities this year?
Yeah, well, bonds are lower duration, so they are less volatile. And first of all, in bonds, you've got to pay the interest.
So low duration, can you explain that?
Duration is just your average maturity, in essence. So consider an equity as a bit like a bond, but an equity has infinite duration because you never get repaid. There's no maturity date on an equity, and you have a variable coupon, otherwise known as the dividend. So equities have infinite duration, and you have a variable coupon being the dividend. A bond has a fixed maturity. It might be 1 year, might be 10 years, might be 30 years bond, and you have an obligation to pay the interest, which is the dividend equivalent in this example to pay. So by definition, bonds are less risky than equities.
Bonds have done really, really well over more than 3 decades for investors. Can it continue?
It's a really tough question, and it's a great question, actually. For various reasons, bonds have had this 30-year downtrend that you speak about. Now, the technicians, so the chartists who look at these things, think bonds haven't really broken out of this downtrend, depending on where you draw the line. But they are...
A downtrend is good for investors,
yeah,
right?
Yeah, exactly. Lower bond yields means higher bond prices. So you've got the 30-year downtrend and lower yields and higher prices. Now, you know, to be honest, I think it's pretty hard for bond yields to keep falling from here. We think bond yields have probably reached their bottom globally. We're just not convinced you've got enough growth of inflation for them to shake out and break the trend line. But they have had a look at the trend line a few times, and depending on where you draw it, on the 10-year US Treasury, the US government bonds, that trend line comes in around 3%, maybe 3.25%, depending on where you draw it. And today they're about 240, but they did get to 265. So a little bit of damage has been done to that trend, but it's not definitively broken. What would break it is a complete regime change. Now, some people would say that could be Donald Trump. It could be the Bank of England or other central banks changing their inflation target. So our inflation target's now 5% instead of 2.5 or 3. or another political event.
So how do you think about the prospects for bonds versus equities in 2017?
Yeah, well, I imagine most of your readers are retired or there's about. So bonds being shorter duration, less volatile, are actually a pretty good match for the expected lifespan of your readers, to be pretty honest. But I would recommend balancing out bonds with equities and other assets to reduce volatility and build up a blended portfolio. I think bonds have got a place.
For retired investors, bonds are a really good match, and for people growing their portfolios for retirement, they can balance out equities really well still.
Yeah, I mean, traditionally equities are for growth and bonds are for income. That's changed a little bit, but I wouldn't expect any growth, as in capital, from the bond markets going forwards from here. I'm not convinced you're going to lose an awful lot. What we always say to our investors is, hey, we're yielding 5.5%. Through the cycle, we'll try and preserve your capital. And if we can generate that 5.5%, we're pretty happy. But they shouldn't expect to make capital going forwards.
John, thank you very much for talking to MoneyWise.
Thank you.